Good morning, everyone. We are the Group 4, and I'm John Paul A. Sinobio, the first presenter. Our topic is about the review of financial statement analysis. But first, let's play a game to refresh your mind about our topic. Name the different financial statements shown in the pictures. Number 1, income statement, statement of cash flows, statement of financial position, and lastly, statement of changes in equity. So, in our major subject, Fundamentals of Accountancy, Business and Management 2 last semester, we already tackled the different types of financial statements. In this report, we will discuss deeper, covering measurement levels, liquidity, solvency, stability, efficiency and profitability, and horizontal and vertical analysis of financial statements. But first, I will enumerate and define the important terminologies about financial statements that will also serve as your review. Financial statements are structured representation of the entity's financial position, financial performance, and cash flows of an entity that is useful to a wide range of users in making economic decisions. There are five types: a statement of financial position, a statement of comprehensive income, a statement of changes in equity, a statement of cash flows, and notes and disclosures. So the first four of the following financial statements, you are already familiar with those. So as a review, I will define the following. So a statement of financial position or balance sheet, it presents the entity's assets, liabilities, and capital as of the period. A statement of comprehensive income or income statement, it presents the entity's revenues and expenses during an accounting period that tells users on whether the entity enjoyed profit or suffered a loss during the period. A statement of changes in equity or capital statement, it presents the changes in equity of the owner due to investments, additional contributions, net income or loss, and personal withdrawals. A statement of cash flows, it presents the entity's cash inflows and outflows on three major activities: operating, investing, and financing. Operating activities include cash activities related to net income, which are revenues and expenses accounts. Investing activities include cash activities related to non-current assets. Financing activities comes from conducting financing activities for the business. In other words, financing cash flow includes obtaining or repaying capital, be it equity or long-term debt. So in this report, we will tackle the following topics: measurement levels, vertical and horizontal analysis of financial statements of a single proprietorship. So to discuss measurement levels, including its first type, which is liquidity, we have Antoinette A. Arsino.
If you're now familiar and able to recall with the important terminologies about financial statements, we will now tackle the following topics. First is the measurement levels, the liquidity, solvency, stability, efficiency, and profitability, and the vertical and horizontal analysis of financial statement of a single proprietorship. Before we discuss the measurement levels, I will first discuss the financial ratios. So what is financial ratio? Financial ratio is one of the most common tools for managerial decision making. Financial ratio are mathematical comparisons of one number to another using a simple division problem. Sabi dito, It involves the analysis of various figures stated in the financial statements para magkaroon ng financial informations about the company's performance. So, nasabi ko kanina, there are 5 measurement levels: the liquidity, solvency, stability, efficiency, and profitability. First, we will discuss what liquidity is. Liquidity refers to the ability of the company to pay maturing obligation. To measure the liquidity of the company, we use liquidity ratios. So what is liquidity ratios? Liquidity ratios determine whether an entity can be able to pay for current liabilities as they become due with the use of current assets. So, ang pinag-uusapan po natin sa liquidity is, kaya bang magbayad ng company ng kanilang mga current liabilities gamit ang kanilang current assets? So, in liquidity, ang titingnan na natin ay ang items related to the company's current assets versus their current liabilities. So, now that we have told that these are liquidity ratios that we will be talking about, here are the formulas. Current ratio, which is the ratio between the current assets and current liabilities, and asset test ratio, which is quick asset over current liabilities, and your cash ratio, which the ratio between the cash and the current liabilities. So as you can see, it is a comparison of your current items versus your current liabilities. Current asset items versus current liability items. So there is a question. Can the company pay for their current liabilities na current assets ang ginagamit natin? So the answer is yes. We will further discuss it. So dito po sa susunod na i-discuss para po mas lalong maintindihan, please refer lang po kayo sa example na financial statement ng Grumpy Cat Company para po mas makasunod ng maigi sa i-discuss. So, let us now discuss the current ratio. The current ratio answers the question, can the company pay for their current liabilities with current assets? Kaya bang magbayad ng company ng current liabilities kung ang patungkulan nating pangbayad ay current assets? The formula again for current ratio is equal to current asset divided by the current liabilities. So, ang gagawin po natin ay balikan po natin yung example given ng financial position of Grumpy Cat Company. Doon po natin huhugutin yung mga amount na andito sa examples. So, always refer po sa example na ibinigay. So, our calculation would be like this. For 2022, kunin nyo po yung current assets for 2022 which is 3,704,701. Divide po natin sa ating current liabilities na 2,283,000 which will give us a current ratio for 2022 of 1.62. And then, current ratio naman ng 2019 is kunin natin ang current asset which is 3,589,755 divided by current liabilities in 2019 of 2,423,000 which will give us a current ratio of 2019 of 1.48. Now, if you're analyzing financial statements, it's not enough that you see numbers. What do these ratios mean? What do these numbers mean? Kaya po nagkakaroon tayo ng ratio interpretation. And what is our interpretation dito? pag sa nakuha natin na 1.62 na current ratio ng 2020 and 1.48 na current ratio ng 2019. So, the interpretation would be, for both years, the entity's current assets are larger than current liabilities. The entity can pay for their current liabilities using their current assets since the ratio is greater than 1. So, ano naman kung greater than 1? Remember that when the current ratio is greater than 1, the entity can pay current liabilities using current assets because the numerator is just your current asset greater than the denominator, which is your current liabilities. So, yan yung gusto natin mangyari. Mas malaki ang current asset kaysa sa current liability. Now, if your current ratio is equal to 1, then your current asset is equal to the current liabilities. But, if your current ratio is less than 1, then the entity cannot pay their current liabilities using current assets. Because what happened is that your numerator is lesser than the denominator. So, anong gusto natin na mangyari? Always ang current ratio ay greater than 1. Ibig sabihin, the current asset is able to cover the current liabilities. So, let's come now to asset test ratio. Asset test ratio answers the question, can the company pay for their current liabilities with quick assets? Pag sinabi po natin quick assets, if you would see po kasi yung ating current ratio, meron po tayong items doon na hindi naman talaga readily convertible into cash. For example, ang inventory. Ang inventory ay kailangan mo pang dumaan sa selling transaction bago mo siya maging accounts receivable. And basically, yung accounts receivable na yun ay magiging cash, di ba? Pero medyo matagal pa bago yung inventory maging cash. Tapos sa current assets naman, for example, prepaid rent and prepaid insurance. Usually, hindi mo naman maaasahan na ma-convert as cash yun, di ba? So, ang ginagawa natin is ina-narrow down pa natin yung analysis natin. And quick assets lang yung gagamitin natin. Sa example po ng Grumpy Cat Company, yun po ay represented ng cash, accounts receivable, and marketable equity securities. Yan po yung mga madaling maging cash na pwede nating ipangbayad ng current liabilities. So, yan po ang ating quick assets. So, our formula in asset test ratio is the sum of cash, accounts receivable, and marketable equity securities, which we can refer to as quick assets, divided by the current liabilities. And the calculation would be, for the 2022, you add your cash of 1,896,337 and your accounts receivable and marketable equity divided by 2,283,000, the current liabilities of 2022, which gives an asset test ratio for 2020 of 1.32. Na susundan po ba? So, habang sinasabi ko po yung numbers, sundan nyo po sa example na financial position sa Grumpy Cat Company yung amounts na sinasabi ko para mas maintindihan. So, let's continue. And then, for the 2019 is 1,256,997 plus 885,697 plus 450,000 divided by your current liabilities for 2019 of 2,423,000. So, the asset test ratio is 1.15. So, pariho lang po ba ang analysis ng asset test ratio at current ratio? Actually po, yes. Kasi ang gusto lang po natin, both of those ratios, dapat greater than 1. Ibig sabihin, yung numerator is greater than the denominator. And when the denominator is greater than the numerator, ibig sabihin, your quick assets can cover your current liabilities. So what would be the interpretation? The interpretation would be, for both years, the entity's quick assets are larger than current liabilities. The entity can pay for their current liabilities using their quick assets since the ratio is greater than 1. Remember that when asset test ratio is greater than 1, the entity can pay for their current liability using quick asset. But if the asset test ratio is equal to 1, quick asset is equal to the current liabilities. But if the asset test ratio is less than 1, the entity cannot pay for their current liabilities with the use of their quick asset. So, naintindihan po ba? Kasi pupunta na tayo sa cash ratio. So, dito na po tayo sa cash ratio. So, this one is igna-narrow down po natin na cash lang po ang titingnan natin. So, kapag nga ba cash ang tingnan natin, ay kaya pa ba natin bayaran ang current liabilities? So, cash ratio answers the question, can the company pay for their current liabilities with cash? So, baka pasado po tayo sa current ratio, asset test ratio, at pagdating natin sa cash ratio, palyado. So, tingnan natin. The formula is total cash divided by current liabilities. The calculation would be, for 2020, cash for the 2020 is 1,896,337 divided by the current liabilities of 2,283,000 gives you 0.83. And for 2019, you do the same calculation. Just get the cash and the current liabilities of 2019 and you get cash ratio of 0.60. Sadly, less than 1 na siya. So, nang i-narrow down pa din natin na cash lang ang titingnan para magbayad ng current liabilities, pumali na tayo. So, the interpretation would be, for both years, the entity's current liabilities are larger than cash. The entity can pay for their current liabilities using their cash since the ratio is less than 1. So, kailangan na natin ng reinforcement. Ano nga ba ang reinforcement? Mag-collect na tayo ng receivable, magbenta ng mga marketable equity securities, magbenta ng inventories para magkapera tayo na pambayad ng current liabilities. Remember that when the cash ratio is greater than 1, the entities can pay their current liabilities using total cash. But when the cash ratio is equal to 1, cash is equal to your current liabilities. And if your cash ratio is less than 1, then the entity sadly cannot pay current liabilities using total cash, which what happened to our analysis. So, yun lang po sa cash ratio. Kung mapapansin po natin sa ating discussion, sa mga example na ibinigay ko, bukod sa kinukompute ay ini-interpret din natin because these ratios has no meaning kung hindi natin siya i-interpret. Yun naman po talaga ang pinaka-essence ng FS analysis. We need to interpret what happening, what we are computing, in order for us to make proper decisions for future operations of the company. So yun lang po. Let's proceed to the solvency ratios that will be discussed by John Martin.
Solvency.
Solvency is the ability of a company to meet its long-term debts and other financial obligations. Solvency ratios determine whether an entity has more ownership rather than debts. So solvency means whether a company can pay its big bills and debts over a long time. Solvency ratios check if the company has more things it owns like money or assets than what it owes like debts. It's like checking if the company is in good financial shape for the long haul. It is also called leverage ratios. These ratios involve comparison of debts, assets, equity, and interest. These ratios help to understand how much a company relies on borrowed money and how well it can handle its debts. So it includes debt ratio equal the total liabilities over the total assets, debt to equity ratio equal the total liabilities over the shareholders' equity, time interest earned ratio equal earnings before interest and taxes over interest expense. So let's tackle them one by one and we start with debt ratio. Debt ratio answers the question how much of the assets are financed by debts. Again, the formula in debt ratio is debt ratio equal the total liability over the total assets. So let's calculate for 2020. In 2020, the debt ratio was calculated by dividing the company's total debts, which is 6,646,694, by its total assets, which is 12,356,216, which equals to 53.79%. In 2019, the debt ratio was calculated similarly. Total debts is 80,174,997 divided by total assets, which is 12,571,442, resulting in 65.03%. So in 2020, the company had 53.79% of its assets financed by debts, while in 2019, this percentage was higher at 65.03%. For both years, assets are financed by debt since the ratio is greater than 50%. So always remember that when debt ratio is less than 50%, assets are more financed by equity. For example, if your debt ratio is 45, then your equity is 55%, so your equity is bigger. When debt ratio is greater than 50%, assets are more financed by debt. When both debt and equity is 50%, assets are financed equally by debt and equity.
Which has more weight, debt or equity? The formula would be debt to equity ratio is equal to total liabilities divided by shareholders. So that would mean that the debt ratio in 2020 is equal to 6,646,694 divided by 5,709,552 is equals to 1.16. And the debt ratio in 2019 is 8,174,997 divided by 4,396,445 is equals to 1.86. So that would mean that for both years, debt has more weight since the ratio is greater than 1. So take note that when debt to equity ratio is less than 1, equity has more weight than debt. When debt to equity ratio is greater than 1, debt has more weight than equity. When debt to equity ratio is equal to 1, debt and equity are equal. Rising debt ratio means the company resort to more debt and more interest expense. Falling debt ratio means the company is shifting more to equity financing. How many times can an entity pay for an interest expense with their operating income? The formula would be time interest earned ratio is equals to earnings before interest and taxes is divided by interest expense. So that would mean that the time interest earned ratio in 2020 is equals to 1,888,384 divided by 12,560 is equals to 150.35. So that would mean that the company's operating income can cover interest payments for 150 times. So take note that the higher the tie ratio, the better. It shows how the company is able to meet its interest obligation with the income that it earned.
This is the long-term counterpart of liquidity. Stability analysis investigate how much debt can be supported by the company and whether debt and equity are balanced. In financial terms, stability is like the backbone of a company. Financial health is not just about having enough cash on hand, but also having a balance between what the company owes. So stability analysis is all about figuring out how much debt a company can handle without sacrificing its long-term health and resilience. It's about making sure that the company's financial structure is sturdy enough to withstand whatever challenges come its way, while still providing opportunities of growth and success. Efficiency. Efficiency ratios measure how well does an entity utilize their assets and resources to generate an income. First, let's talk about the asset turnover ratio. This is like looking at how many loaves of bread you're selling compared to the ovens, mixer, and other equipment you have in your bakery. If you're selling a lot of bread with the same equipment, it means you're using the asset efficiently. However, if you're not selling much bread despite having all this equipment, it suggests that you might need to improve your efficiency in using those assets. The turnover ratio. This is similar to checking how quickly you're selling the ingredients and finished products in your bakery. If you're turning over your inventory quickly, it means you're efficiently using your ingredients and not letting them go to waste. But if your ingredients are sitting on the shelves for a long time, it could mean you're typing up your money in inventory that's not generating income. And the accounts receivable turnover ratio is like examining how quickly your customers are paying you for the bread they bought and credit. If your customers are paying you promptly, it means you efficiently managing your accounts receivables and keeping the cash flow. But if you're waiting a long time to get paid, it could indicate
how many times can an entity generate sales with their total asset resources. So the formula is asset turnover ratio equals net sales divided by average total assets. So asset turnover ratio equals 4 million divided by 12,356,216 plus 12,571,442 divided by 2 equals 0.32. So the company's asset can only generate sales 0.32 times. So remember that the higher the tie ratio, the better. It shows how the company is able to generate sales from the resources. Second, how many times can an entity sell their inventories and have it replaced within a period? So the formula, inventory turnover ratio equals cost of goods sold divided by average inventory. So, inventory turnover ratio equals 1,630,880 divided by 677,520 plus 756,442 divided by 2 equals 200.27. So, the company's inventory turnover is low. So, a low turnover might mean a weak sales and excess inventory. A high turnover might mean strong sales and insufficient inventory. So next, how many times can an entity turn the receivables to cash for a certain period? So the formula is accounts receivable turnover ratio equals net credit sales divided by average accounts receivable. So accounts receivable turnover ratio equals net credit sales divided by average accounts receivable. So accounts receivable turnover ratio equals 4 million divided by 653,974 plus 885,697 divided by 2. So equals 5.20. So, in a period, the company turns receivable into cash 5.20 times. Remember that a low turnover signals weak collection efforts, a high turnover signals strong collection effort.
Profitability ratio. Measure how well does an entity generate income that relates to their revenues, operating costs, assets, and capital. So we have gross profit ratio, return on assets, and return on equity. So let's discuss them one by one. Gross profit ratio. How much gross profit ratio does the company makes after considering cost of good that were sold? So, pira kuno ka percent ang aton natubo sa pagbebenta. Remember that net sales minus cost of goods sold is tubo. Gross profit is tubo. So, our formula is gross profit ratio is equals to gross profit over net sales. So, for 2020, gross profit is 2,369,120 divided by 4 million. So, our gross profit ratio is equals to 59.39% for 2020. So, that 59.23% of sales is an ating result or an ating tubo. Remember that gross profit ratio represents the amount of gross profit for every 1 peso sale. So, let's proceed now to return on assets. Diba nagkakayoan ka naman kita, magkano ang binalik sa sa paggamit mo sa asset. So, you just simply divide your net income to your total assets, which is your net income is 1,313,077 over your total assets is 12,356,216 is equals to 10.63% ang binalik sa aton assets. Siyempre, ginagamit natin ang assets para kumita, and that 10% return yung ina-enjoy ni company in the usage of their assets. So, remember that the higher the returns, the better. Now, return on equity. How much income was returned in the usage of equity to generate profit? Or, magkano ang bumalik sa shareholders' investment? So, you simply divide net income to your total shareholders' equity, and same process. You just divide your net income, which is 1,313,077 over 5,709 1,522, which gives you a return on equity of 23%. The entity enjoyed 23% returns sa ating shareholders' investment or sa ating equity. Same approach with return on assets. The higher the returns, the better.
Vertical and horizontal analysis of financial statements of single proprietorship. The financial health of a single proprietorship business is checked through analysis of financial statements using a lot of different methods. The most commonly used methods are horizontal analysis and vertical analysis. Horizontal analysis. This method analyzes the trend of the company's financial information over a period of time. Each line item is examined, specifically the percentage change from the previous period. The horizontal analysis, each line item in the financial statements such as revenues, expenses, assets, and liabilities is analyzed to determine the percentage change from the previous period. By calculating this percentage change analyzed, can gain insights into the company's financial performance and make informed decisions about its future prospects. Horizontal analysis helps stakeholders understand whether the company's financial position is improving, deteriorating, or remaining stable over time. Vertical analysis. This method compares a relationship between single items on the financial statements to the total transaction within one given period. It will show the percentage of change of the financial information from the last period and can be performed on the both income statement and balance sheet. Vertical analysis is another method used to analyze financial statements by comparing individuals' line item to a key figure within the same period. In vertical analysis, each line item on the financial statement is expressed as a percentage of another item on the same statement. The key figure used as the base for comparison is typically total sales or total assets. Horizontal analysis focuses on analyzing trends and change in specific line items over time, while vertical analysis emphasizes comparing individuals' items to a common best figure within one period to evaluate their relative significance.
So now we will be tackling the horizontal analysis. It states here that it is the comparison of the historical financial information over a series of reporting periods to show trends and changes as a tool in making decisions. The intent is to have more detailed analysis of the reason for the difference in amounts, specifically those that are unusually high or low in comparison to the information for relating periods. The conduct of a horizontal analysis for all the financial statements at the same time is useful in scrutinizing the complete impact of operational results on a company's financial condition over the review periods. So basically, i-compare tala horizontally or pahigda ang financial information sa mga reporting periods para makita ta ang trends and changes na nangyari sa at business or sa company. Dito makikita ang detailed analysis para mas maintindihan tasin maupay ang reason sa pagkakaiba-iba sa mga amounts. Ngan madidetermine tata if may improvement ba, kung nagataas ba, or kung naghamubo ba ang amounts over the years. And this will help us to make plans and decisions so that our business or company can thrive. So now, makadinakit sa horizontal analysis of the income statement. So didi makikita ta ang kita ngan gastos san sayo na business or company. Now we have here a picture of comparative balance sheet for 2018 and 2017. So makikita man niyo sa picture and changes sa sales, cost of goods sold, gross margin, and operating expenses, and so on and so forth. I know na aram na niyo kung paano kuhaon ang variance ngan percentage, di ba, sa sito grade 11. So paano ba otro? Ima-minus ta ang current year sa prior year, which is ang 2018 and 2017. Kung makikita niyo sa picture, sa 2017 mayaon kit sales nga 2,500,000. Pag-abot sa 2018 mayaon kit 3 million. So igma-minus ta iton nga duha. So 3 million minus 2,500,000 is equals to 500,000, which is an iyo na variance. Same ta ang process na himuon sa cost of goods sold, gross margin, and so on and so forth. So sa percentage man, ang himuon ta para makuha siya is i-divide mo ang variance sa base year. Nano ang base year? Ang pinanggalingan or ang ginsusugad ta na prior year. Ito na ang 2017. So, if divide ta ang 500,000 divided by 2,500,000. Ang magawas iton nga result is 20%. Same ta ito ng process, sunod-sunod ta, same ta. Nga dinakit sa interpretation, number 1. Abagaw day, sales have increased at a higher rate than cost of goods sold. So, sa makikita man diba ni sa picture, ang sales naghataas siya 20% while ang cost of goods sold is 14%. This could mean that more sales activities were undertaken which increased sales at a minimal increase in cost. So this means na an company was able to generate more revenue with a relatively smaller increase in the direct cost. Or sugaron ta naghimo sira or nag-implement sira sin more effective sales and marketing strategies, which lead nga nagkayoon sira or nakabaligya sira sin more units without significantly increasing the associated cost. Interpretation number 2. Bagaw, gross margin and all operating expenses have increased due to the corresponding increase in sales and cost of goods sold. So, kaynano naapektuhan ang cost of goods sold? Kaynano naapektuhan ang operating expenses? So, una, pag nag-increase ang sales, typically nagli-lead siya to a corresponding increase lahat sa cost of goods sold, or the cost of producing or acquiring the products that were sold. Panduha, pag nag-increase ang sales and cost of goods sold is directly na mag-i-impact or nag-i-impact na iton sa gross margin. Kaya diba, para makuha ang gross margin, kailangan ta minus ang sales and cost of goods sold. Sa picture, sa 2018, ang sales ta is 3 million. Sa cost of goods sold is 1,600,000. Pag i-minus ta iton nga duha, ang kakalabasan siton is 1,400,000, which is ang gross margin na. Number 3. Pag ang sales ngan ang business activities nag-increase, ang operating expenses liwat siton niya is mag-i-increase para masupport ang higher level of operations. Nano ba ang mga operating expenses na adi? Ini nga salaries and wages, an office rent. Actually, damo iton siya, pero since na-cut off ang picture, dire na mapapakita ang iba. So, all in all, pag nag-increase ang sales and cost of goods sold, magka-create siya sin ripple effect. na nagkukos both gross margin and operating expenses to rise as well. This is because the higher sales and production levels require more resources and incur more costs to support the expanded business activities. And since financial statements are interconnected, ang changes sa sayo na area apektado na liwat siton ang iba na related accounts. So sa interpretation number 3, ang bago dide, the profitability of the business has greatly improved in 2018 with the increase in net profit by 38.9%. Direkta siya mapakapakita kay sugad ko pa kanina na cut off ang picture. So, good sign ini siya since nag-increase ang net profits in 38.9%. Nag-indicate la ini nga dako agin improve sa overall profitability sa company or business since higher net profit means na ang company or business is nag-generate siya sin more income relative sa expenses, which can lead to good financial health and performance. So, nga dinakit sa horizontal analysis of statement of financial position. So, sa picture, makikita mo man ang changes sa assets, liabilities, and equities sa company over the years. So, oo, same ta sini ang process sa pagkuha sa variance and percentage nga ginhimo sa income statement. Sa horizontal analysis of the income statement. So sa interpretation number 1, ang bagaw dide, the liquidity of the business has improved in 2018. This is reflected by the increase in total current assets compared to the decrease in total current liabilities. An improved liquidity is very important talaga siya when it comes to business. Kaya this only means na the company has a stronger ability to meet its short-term obligations and carry niya makover ang day-to-day operational expenses. So pag the increase in current assets relative to current liabilities suggests that the business has more resources available to pay off its short-term debts. However, the increase in accounts receivable in 2018 means that the business must exert extra effort in the collection to avoid doubtful account expense. So sa picture, ang accounts receivable is nag-increase talaga siya sin 18.33%, which is concerning kay this only means nga nag-iiha ang company or business san pagkolekta sin payments from its customer. Na this can tie up the company's cash flow and increase the risk of bad debts, which is maapektuhan talaga sinto the EU business and or company. Ang bagaw pa dide, the increase in inventory in 2018 means that the business has too many stocks of inventories where if not sold immediately will result to losses. Actually, problema talaga insan sayo na company or sayo na business pag unable na mabaligya dayon ang excess stock, matik, lugi dayon. Kasi pag damo ang iyo unsold inventory, pwede in mag-lead sin storage cost, and dako talaga ang posibilidad na malugi iyo business or company. Sa interpretation number 2, ang bagaw, the solvency of the business has also improved in 2018. This is reflected by the decrease in notes payable, which means that the business has honored the commitment in paying its obligation. So, good sign ini siya sa company's solvency, kaya this only indicates na ang company is carry niya mag-pay down sa kanya mga long-term debt obligations. In interpretation number 3, it states that the main source of business financing in 2018 is capital, primarily from the profits rather than additional contribution by the owner. This is reflected in the increase in capital by 56.71%. Sa picture makikita niyo ang owner's capital is ada siya sa 56.71%. So basically nagpapaimod ini siya na ang company mas nagre-rely siya sa internally generated funds para mapondohan ang operations and growth sa company or sa business. So sign ini siya sa good sign of financial stability and self-sufficiency.
And now let's move on to the vertical company financial statement analysis. So it is the proportional analysis of each line item on a financial statement in a percentage form. The process will involve computations of every line item on an income statement is stated as a percentage of gross sales, or every line item on a statement of financial position sheet is stated as a percentage of total assets. So vertical analysis is also being used for time series analysis to analyze relative changes in amount balances over a period of time, such as a comparative basis over a 5-year period. And as for Sir Chua, vertical analysis is the method of analyzing financial results, expressing each financial statement account and element as a component of a base. So what is a component of a base? In the vertical analysis of the income statement, the base or the component of a base is the sales. So to solve for the component, we have to solve mathematically where the numerator is the account that you wanted to analyze. For example, is the cost of goods sold, the gross margin, etc. And the denominator is the base, which the sales in the income statement, where 1,600,000 is the cost of goods sold divided by the base, which is 3 million, and equals to 53.33%. And for the interpretation, which the cost of goods sold is 53.33% of sales, which means that for every 1 peso of sale, 0.53 centavos represent the cost of goods sold. Likewise, the total expenses are 34.82% of sales, which also means that for every 1 peso of sale, 0.34 centavos goes to the operating expense. So in simple terms, the entity's cost of goods sold comprises of 53.33% of the entity's assets in 2018, in which for all the sales or for all the base, 53.33% is on cost of goods sold, while 34.83% is on the expenses. Which means that for every peso na naibibenta ng entity or the company, ang 53.33% is naipupunta sa cost of goods sold. In summary, after deducting the cost of goods sold 53.33% and the operating expenses 34.83%, only 11.83% is left as profit. The business can consider this information in making a decision like reducing the cost of goods sold to increase the profit. And as for vertical analysis of a statement of financial position, the base are the total assets and the total liabilities and owner's equity. So to solve for its component, we have the account that you wanted to analyze for the numerator and the base for the denominator, in which sa cash, which is 235,000 divided by 1,913,800, which is 12.28%. So to analyze it or to interpret it, where, for example, is the cash, in which in all the entity's assets, cash is 12.28%. If tagalugin ko sa lahat ng pagmamayari ng entity, 12.28% is nasa cash. The resources of the business are tied up to the inventory, which is almost 25% of the total assets, while the accounts receivable is about 19% of the total assets. The business can consider this information as a go signal to improve the collection of effort and manage its inventory. Also, the business can consider also to settle its notes payable to avoid interest expense and improve its profitability. And as for what Sir Chua said, walang saysay ang mga percentage na nakalagay sa financial statement if hindi ito natin gagawin ng interpretation.